Our companies need capital to run their operations, expand market shares, and in some cases, undertake acquisitions so as to be able to grow. And when it comes to raising this capital, a very important avenue is through the issuance of what is called corporate bonds. So in this particular video, I want to talk about the essentials of corporate bonds. So here are the key features of corporate bonds you need to be familiar with as a would-be investor. Number one is the issuer, that is the issuer of the bond. Our corporate bonds are debt instruments issued by companies or corporations to raise capital for various purposes such as financing projects, acquisitions, or refinancing existing debts. So whatever they want to get involved in, there's always a need for them to raise capital as a result. And one of these ways is through the issuance of corporate bonds. And not only that, number two, there is that fixed interest rates or fixed interest payments. When it comes to interest payments, the corporate bonds typically pay periodic interest known as a coupon to their bondholders. It might be annually, it might be semi-annually, thus providing regular income for their bondholders. And the interest rate is fixed, at the time of issuance. When they issue these bonds, they come with a fixed predetermined interest rates, and these rates, are paid regularly to those who invested or who are, bondholders of these issuing companies. Number three is maturity dates. When it comes to maturity date, the corporate bonds have specific maturity date, typically ranging from a year to as high as 30 years. So at maturity, the principal, or what is called the face value, is repaid to the bondholder, at the end of the day. So the bondholder has that particular benefit of having regular income through coupon payment, interest payments, and as well as at the end of the duration of the bond, the bondholder, gets to collect his capital, his initial fund back. Number four is face value. So face value here actually is what is called the par value, of the corporate bond, and it is the amount the bondholder will receive at maturity. So when the bond matures, when the duration is over, so the money that the investor earlier invested in will be returned back to the investor concerned at face value. And not only that, number five is credit rating. Credit rating. Corporate bonds are rated based on the credit worthiness of the issuing company. How credit worthy is the company issuing it? So the rating ranges from what is called low risk of is rated based on the possibility of default. There's low risk of default to a higher risk of default. So there's what is called high yield or junk bond. These particular bonds, the issuing companies are like having financial difficulties. They come with very high yield, relatively higher yield, but the risk of default is equally very high. So it's left for you to be able to weigh your risk tolerance as regards the possibility of default and the interest or the coupon you receive at the end of the day. So if you feel you can cope, you can bear with the risk involved, you can go ahead and you invest in junk bond. Number six is yield. The yield on a corporate bond is the effective return, the investor can expect, which is influenced by the bond's interest rate as well as the surrounding prevailing market condition. So higher yields are typically offered for bonds issued by riskier companies. Look at the irony of the whole matter. So the riskier the company is, the more the yield on the bond the issue tends to be. And the safer the company financially, the lower the lower the yield, the coupon yield on the bonds issued. Please like this video and subscribe to this channel if you've not done that. Number 7 is callable or non-callable. Some corporate bonds are callable, meaning the issuers can redeem the bond before reaching the maturity date. For instance, if the maturity date is like maybe 3 years or 5 years, the bondholder may decide to retrieve the bond before then. So you have non-callable bonds. These particular one are not callable. So they have no, this feature is not really there. When they mean 4 or 5 years, they mean, when they say 4 or 5 years, they mean 4 or 5 years. They cannot recall the bond before the duration is over. Number 8 is convertible bonds. Some corporate bonds are convertible, allowing bondholders to convert their bond into a predetermined number of company shares under certain conditions. If you're a bondholder, if the condition is favorable, you can convert your bond into securities, into the stock of the issuing company. That is a convertible bond. You equally have, covenant. When it comes to covenant bonds may include covenants which are clauses that impose a certain restriction or obligation on the issuing company, such as limits, on additional borrowing or requirements for maintenance, for maintaining certain financial ratios. When it comes to this particular aspect, the company, has to the company is being placed under a certain restriction. In other words, they cannot borrow, money beyond a certain limit. And not only that, the balance sheet strength, is equally monitored, because certain financial ratios have to be taken into consideration, which should not be exceeded. Number 10 is secondary market trading. Secondary market trading. Corporate bonds, can be bought and sold, in the open market, in the secondary markets, and their price fluctuates based on factors like changes in interest rates, as well as economic condition, as well as the credit risk of the company involved. So this price tends to fluctuates around the par value or the face value of the bond concerned, and they are influenced by interest rate, credit worthiness, and market conditions. Number 11 is secured or unsecured. When it comes to this particular concept of secured or unsecured bond, it simply means that bond can be secured, meaning they are backed by specific assets of the issuing company. It may be property, it might be equipment. So in case of default, the bondholders can sell the assets and then recover their money. Then if it is unsecured, the bondholder have no claim on the specific assets but are paid from the company general assets. You understand? They could still be paid, but not from any secured specific asset. But when the assets are disposed, the bondholder could be paid this money at that instance. Number 12 is tax treatments. When in relation to tax treatment here, the interest income from corporate bonds are generally subjected to federal, states, as well as local taxes, making them less tax efficient than government securities like municipal bonds, like government bonds. And so the federal government will tax, the state government will tax, and even the local government may equally tax, the interest on the bond. So the future makes And these features make corporate bonds a popular investment choice for those seeking regular, stable income, those seeking diversification, and those that equally have the risk appetite to be able to cope with the various risk exposure, as it relates to the credit worthiness of the company issuing these bonds.